Okay. Good morning, students. This is the second lecture we are going to cover on the subject strategic financial management. Now, the topic which we are covering is foreign exchange exposure and risk management. And I am CA Pravesh Ali, who will be covering this lecture for this topic for you. Now, this is the second lecture. We have covered the basics, most of the basics we have covered. And today we'll be just, we were doing some questions. And we'll carry on to do one or two questions and then move on to the second topic. So let's begin. This is exercise 17, continuation of the first lecture. So this talks about a question where it says that following two-way quotes appear in the foreign exchange markets. Okay, so the quotes are given, the spot rate and the 2 months forward rate is given to you. This is, a dollar quote, which is spot rate is 46 rupees, the bid price, and 46.25 is the ask price, which is given for the spot rate. And 2 month forward rate is also given, where the bid price is 47 and the ask price is 47.50. So these two quotes are given to you, a forward as well as 2 months forward. And if you look at the quote, this is a reverse notation because it is given rupee dollar. So it should have been actually dollar rupee. So we should treat this as $1 is equal to 46 rupees and 46.25, and similarly for the 2 months forward contract. Now, what is required in this question is how many dollars should a firm sell to get 25 lakhs after 2 months? So this is the first part of the question, which he says that, how many dollars you will get if you sell to get 25 lakhs after 2 months. So that means we have to look at the 2 month forward rate here. The second question is how many rupees is the firm required to pay to obtain $2 lakh in the spot market? So basically this here we will look at the spot rates. Then the third part of the question is assume that the firm has $69,000 in a current account earning no interest, whereas the return on investment on rupee investment is 10% per annum. Now, should the firm encash US dollars now or 2 months later? So there are three parts to this question, and we will solve one by one. So let's begin with the first one. But before we proceed to the first one, so we look at the question again. The following two-way quote appears in the foreign exchange market. The spot rate is given to you, a dollar, rupee dollar quote, and then a 2 month forward rate is also given to you. And then, the three questions which we have already discussed. Should the firm, encash the US dollar now or 2 months later? So this is the question. So let's begin with now the solution. How many US dollars should a firm sell to get 25 lakhs after 2 months? The question is, how many US dollars should a firm sell to get 25 lakhs after 2 months? So now, we have been given this quote. This is, a forward quote because he's talking about, how many dollars should a firm sell after 2 months. So we look at the forward rate. So the forward rate is, we can split the forward rate like this. $1 is equal to 47 bid rate and 47.50 ask rate. But this is a dollar rate. Okay, so we need to convert this into a rupee. And I'll tell you why. Because we want to get 25 lakh rupees. Okay, fine. So, selling dollar, because we want to sell dollar and buy rupee. So, which is, selling dollar means buying rupee. So, if we have to buy rupees worth 25 lakhs, we should have a rupee quote to make the matter very simple. Okay, we would have solved it other way also, but if we convert it into a rupee quote, then we can just simply multiply 25 lakh rupees with the desired quote and we get the answer. Now, here, it is 25 lakhs now. In this case, he is going to buy rupee. Fine. So buying rupee, when we look at the ask rate. Ask rate is the bank's buying rate, and for the customer point of view, it's a selling rate. So he wants to sell dollars by and converting them into rupee. So here we look at the ask rate. So 25 lakh rupees multiplied by 1 divided by 47. Okay, or we can say 25 lakhs divided by 47 straight away, and we get $53,191.50. So this is the money which he will be getting. This is in dollars these many dollars should he sell to get 25 lakh rupees? So he needs 53,191 rupee 50 cents of worth of dollars to get 25 lakh rupees. Here we multiplied with the ask rate. And I again repeat, ask is basically from your point of view, from the customer point of view, it is a, his selling rate. That means his dollar selling rate. Okay. And customers buying rate, up to the bank's buying rate. So now, the second part is how many rupees the firm required to pay to obtain $2 lakh in the spot market. So, here the customer wants to, obtain $2 lakh in the spot market. So he wants to buy $2 lakh. Okay. So the rupees for dollar spot rate is given to you, and which can be spread like this. So $1 is equal to 46 and 46.25. So bid and ask rates are given to you. And it's a pretty straightforward question because he wants to, obtain $2 lakh. He wants to buy dollars. Okay. So when you want to buy dollars, then you look at the bid rate, which is basically the rate at which you are going to, we have to look at the ask rate because you want to buy dollars. Okay. So the ask rate will be the important here, and he will be buying at 46.25. So because when you sell, you will get 46 rupees, but when you buy dollars, you have to pay a higher amount. So, ask is always higher than the bid. So he has to pay 25% more here. So the rate will be 46.25. So that means $2 lakh multiplied by 46.25. So he will get 92 lakh 50,000 rupees. So in this question, it's a pretty straightforward question. He wants to obtain, he wants $2 lakh, which is a normal classic case when you go abroad or when you are making a payment in dollar terms. So you look at the dollar quote and look at straight away at the ask rate, which is basically your buying rate. Okay. And your buying rate is 46.25. So multiplied by 2 lakh. So you get 92 lakh 50,000. Then, last part of the question is, assume the firm has $69,000 in a current account, earning no interest. So ROI, which is the return on investment on rupee, is 10% per annum. Should the firm encash the dollar now or 2 months later? So first we will see that, suppose he encashes now, how much he gets. So he's encashing, 2 months versus 2 months later. So let's see. So the spot rate is 46 rupees and 46.25. Okay, so he wants to encash it. So he wants to sell dollars. So here we will look at the dollar selling rate, which is the bid rate, which is 46 rupees. Okay, here we look just the opposite because here he wants to sell the dollar. He's not buying it, so he's selling. So we look at the bid rate, which is actually the buying rate of the bank and your selling rate. Okay, so if we can encash in the spot market, then how much it will be converted into rupees? So it will be 69,000 multiplied by 46, which is the selling rate. Okay, so he gets 31 lakh 74,000. So now, since he has converted today, he will get 10% return. So he's going to park his money somewhere and he's going to get a return of 10%. So which will be, 10 divided by 100, which is 10%. And it will be for 2 months because we want to compare, what he'll be getting 2 months from now and what he's getting today, plus the interest on for the 2 months. So he gets 52,900 as an interest on that. So the total inflow to him will be 32 lakh 26,900. So if he encashes today, he gets, along with the interest of 10%, he gets 32 lakh 26,900. But then what happens? Suppose he does it, say, after 2 months, he wants to encash. So proceed if he can encash it by a forward rate. So the forward rate is given to you. $1 is equal to 47-47.50. So that means he is going to encash it at 47, which is actually the bid rate of the bank, and for you it is the buying rate. Basically you want to sell the dollar. Okay, so 69,000 into 47 rupees. So the dollar selling rate is 47. So he gets 32 lakh 43,000. So now if we compare the two, in this case he's getting 32 lakh 43,000. In the forward market he was getting. Now he's getting 32 lakh 43,000 in the forward rate, and the spot rate was giving him 32 lakh 26,900. No, definitely the forward is better, so he should wait. Okay, it is better to encash the proceeds after 2 months. So this is basically the answer. Good morning, Chavi and Sumit Jain, you have joined. Okay, great. So I hope you have understood this question. If you have any query, you can just raise it on the chat line. So now we come to yet another concept, which is called the pips, which is also a very, very important concept. Okay. So what is the full form of pips? Price interest points, pips. So here, basically, pip is the smallest price move that an exchange rate can make. So the smallest change happening to the foreign currency rate is called the pip. Now, most currency pairs are priced out to 4 decimal places. Okay, so it will have like $1 is equal to say 73 or 74.4526. So it's up to 4 decimal places. Okay, so the pip change is the last decimal, the 4th decimal point. Okay, fine. So in an Indian interbank market, USD dollar rate is quoted to up to 4 decimal points. Okay, so it is the 4th decimal point which you should look at. So hence the minimum value change will be the tune of 0.001 paisa, okay, or rupee. Fine. So this is the minimum change the quote can have. So this is called the pip. So the concept is very simple. Okay. So it's not difficult to follow. So let's look at say example. Okay. Suppose the spot rate is given for Euro USD. Now it is quoted at a bid price of 1.2313 and the ask price is 1.2319. Now if you look at this quote, this is actually again a reverse notation because 1 euro will have more dollars. Okay, so it is not like $1 is equal to 1.23, but it is 1 euro is equal to 1.2313, and ask price is 1.2319. So the difference is USD 0.0006 because it is 1 euro is equal to $1.2319. So the pips is basically is equal to 0.006 US dollars. Okay, so 6 pips. So if you look at on your screen, look at the top where the quote same quote is given some other time, it is this 1.1402, and then of course there is a figure called 7 also, but we should look at the 4th decimal place. So 2 is the 4th decimal place. This represents 2 pips. Now the 5th is called the pipette. So we should ignore it for the while when we are discussing and understanding pips. Okay, so if you look at here also it is 1.1538. So 8 is pips, so it is 8 pips. Okay, and if you look at 2, which is called the pipette, so it is 0.2 pips. Okay, so when you look at 3, it is 30 pips. Okay, ignoring the 8, so it's 38 pips altogether. So similarly, the 5 will be called 500 pips. Now, why it is important? Because in the forex trading, normally the traders would say that I have made 25 bips. 25 pips, profits. So they don't talk about, in terms of, the currency, either rupee or dollar or whatever currency they're talking about. So they talk about, how many pips they have, lost or made. So if you look at this, this is, the Euro USD quote has moved from 1.232 to 1.2347. So which means the rate has gone up by 25 pips. Okay, suppose somebody has taken a long position at this point, so he will be making a profit of 25 pips. So he'll say, I've made 25 pips. Okay, so some more relevance to it, but we'll discuss that later in our questions. So, so it is the smallest unit by which the currency can change. Okay, so we know that now. So USD Euro, look at the, the USD INR quote. Suppose the quote is 61.75. Suppose that is a quote which is given to us. So the minimum value this rate can change is between 61.74 to 61.76. That means it is going up 1 paisa less or 1 paisa more. So, but of course, we understood that is the 4th decimal place. But if you are looking at a 2 decimal quote, then it will be the pip value will be 0.01. But normally we look at the 4th decimal point. So this is a question just to, example to explain, but it is the 4th decimal place which is important and which is coming up again here. So in other words, for US dollar quote, the pip value is 0.01. Pips in foreign currency quotation is similar to tick size in the share quotation. Now, when we are talking about share market, so we talk about tick size. So the minimum, the change which happens to the share price. So it is called tick. So just to distinguish between the stock market and the currency market. So in the currency market, we call it pip, and in stock market, we call it tick. Okay, so we'll try to understand that little later when you are doing your derivatives on your stock markets. Okay, so however, in Indian interbank market, USD INR rate is quoted up to 4 decimal points. Okay, so hence the minimum value change will be to the tune of 0.001. So a pip will be the last, digit, the 4th decimal place. Fine. So suppose the quote is given that Euro USD is quoted at a bid price of $1.2313 and ask price is $1.2319. So the difference is USD 0.006, which is equivalent to 6 pips. So that means the difference between the bid rate and the ask rate is basically 6 pips points. Okay. So it can be understood by various examples and how it is used and how it is worded in the markets. Okay. So this was what we covered, the basic concepts. Now we'll move on to the second part, which is little bit more basics, and then we'll start doing some questions more from your CA practice manual and your past exams. So let's move on to the second part of it, and I have given the slides to you now, and the exercise is also been given to you, so you can just go through that. So let's understand now the second part. Okay. So basically now we are moving to the second part, and we are going to understand some little bit more basics on forward contracts, rates, and other basic concepts. Okay, and then we'll move on to more difficult questions. Okay, little later part of the day today. So foreign exchange quotation. Now, how this quotation is given, and we have some brief idea up to now, but a forward contract is an agreement between two counterparts to exchange currencies to exchange currencies on a future date at a rate fixed in the contract. So it is an agreement between two parties to exchange currencies, okay, on some future date at a rate which is fixed in the contract, which is done today itself. Okay, so we actually book a forward contract. So we book the rate also as of today. Okay, but everything happens on the future date. The delivery and the money payment happens later. So forward rate is quoted with spot and forward margins separately. Now this is the way normally how the forward rates are given. So you will be given a spot rate and forward margin, or the swap points will be given to you. Okay, so it will be like this. The spot rate is given to you. Okay, fine, which is $1 is equal to 75.53 stroke 54. For simple reason, we have taken a 2 decimal place code to understand the concept. And 6-month forward rate is 40/44. Okay, normally the bid points will be always lower than the ask point. So it is coming in right foot, 40/44. But it can be given a reverse also, but I'll explain you that later. Okay, so it is 40 and 44. So it will be an increasing order if the dollar is quoting at a premium. So we'll understand that very shortly. Now there's a question from Sumit Jain. We have to take values up to 4 decimal points while solving forex problems. Now it all depends upon the question. If it is coming 2 decimal places, up to 2 decimal is given, then you have to solve it up to 2 decimal. But it is up to 4 decimal places, then you have to solve it up to 4 decimal places. So we'll understand the whole gamut about these 4 decimal places and how it is the questions are solved in a later part. Today itself will be coming some questions. So we will be able to understand that. So don't worry, we will be covering very shortly on that point also. So $1 would be the forward rate if you have to calculate. So we have to just add the swap points. 40 is equal to 0.40, okay, and 44 is equal to 0.44. So we are just going to add, and then we get a 6-month forward rate, which is $1 is equal to 75.93/98. So the spot rate and the forward margins will be given to you separately, and you have to just plug them up, okay, and get the forward rate. So there's a pretty straightforward, way of doing it, but there are some ways which get a little complicated, but that we'll be covering a little later. First, understand the simplest way how it is arrived at. Now, if the price on a future date is higher, then the currency is said to be at a forward premium. Now, in the example which we did, so that means the US dollar was at premium. Okay, fine, because the rates were going up in the future, the forward rate. So if the price on a future date is lower, then the currency is said to be at a forward discount. So either a currency will be trading at a premium or a discount, and we'll do some exercise to really understand that concept. So in the example, US dollar is at premium. So what example which we discussed was that US dollar is at premium, and the forward premium of US dollar for 6 months is 40/44 paisa for buying and selling rate respectively in the interbank market. Okay, fine. We have already covered some part of what is interbank market, but we will be covering a little bit more today itself. Okay, so forward premium and discount. We know that a forward rate will carry either a premium or a discount. A forward premium is a situation in which the forward or the expected future price for a currency is greater than the spot price. So a forward premium is such kind of a situation where the forward rate is more than the spot rate. A forward premium is frequently measured as difference between the current spot rate and the forward rate. So if you want to know what is the kind of a difference, okay, suppose the full quote is given to you, so you minus the current spot rate with the forward rate, and you know what is the premium. So when the forward premium is negative, it is equivalent to discount. Okay, so either the premium, either the currency will be trading at discount in future, okay, or it may be traded at a forward premium. Okay, now if you look at the dollar rupee code, always dollar will be always having a premium most of the time. Okay, right? And we'll understand the logic why it is so. As with the case of spot rates, there is a bid and ask spread on forward rates also. So even the forward rates have both the bid and ask. So we have done that example earlier. So forward rates may also contain a premium or discount. So, and then if the forward rate exceeds the existing spot rate, it contains a premium. If the forward rate is less than the existing spot rate, then we say it contains a discount. So let's now do some questions. Okay. So I like you to participate in that. So first question, I will be doing it myself as an example, and then you try to work out the answers for yourself and let me know on your chat line. Now this is the formula for calculating annualized forward premium or discount, which will be there in a currency. So it is forward rate minus the spot rate divided by spot rate, and we multiply it by 360. We always take the year as 360 for calculating the premium or discount, and divided by n. N is the period. Now it can be a 2 months, 3 months, 4 months, 6 months. So depending upon the number of days actually, because it is 360 days, so n has to be in number of days. Okay. So suppose the spot rate is 76.12. Okay, so the dollar is today trading at 76.12, and 90-day forward rate is say 77.05. Then how do we calculate the premium? Because the 90-day spot rate is higher, 90-day forward rate is higher than the spot rate. So we take 77.05, which is the forward rate, minus the spot rate, which is 76.12, divided by the spot rate, which is 76. So we then multiply it by 360 divided by 90 days, because it's a 90-day quotation here. So multiply by 100 to get percentage. So that means we say that dollar is at a forward premium of 4.88%. Okay. So now it's your turn to do it. Suppose this is the formula. Suppose the dollar rate is 76.12. 1 year forward rate is 79.97. Required, calculate the dollar forward premium or discount. So please do it. So here the spot rate is given and the forward rate is given. And mind you, it is a 1 year forward rate. Okay, so the formula we know, it is written on the top, which is forward minus the spot rate divided by the spot rate. Then you multiply it by 360 and divide by, in this case, 1 year itself. So what will be the answer? So I hope you have already done. So I'm just going towards the answer very shortly. So by the time I just pose this answer on the screen, so by the time I hope I'll get some kind of replies from you. So here we are getting the answer. It is 79.97 minus 76 divided by 76 into 360 divided by 360, because 1 year into 100, so we get 5.05%. Okay, so that is the premium on the dollar. Okay, so I'm still waiting for some answers to come. In the meantime, just wait for a while, and so yeah, I think I have not got answers. Ambika, you've done it well. 5.06, wonderful. Sumit Jain has also done it. Kaustav is also done. Chavi, yeah, you're all right. Okay. So now, let's look at, one more question, okay, which you need to solve it. Now here, suppose the pound spot rate is 1.25. Okay. So pound spot rate is 1.250 and 90-day forward spot rate for pound, the 90 days pound forward rate is $1.243. So look at the quotation here. The 90 days is actually showing a lower figure than the spot rate. So that means your answer should be coming in discount here. Okay. So there will be a discount. So that means the pound is trading at a discount compared to dollar in a forward market. So calculate the pound forward premium or discount rate. Okay, fine. So please do it. I think now you can do it. It's a 90-day forward rate. Okay, fine. So I'll just see if I've got the answers from you. So now I'll just be showing the answer here. So it is at a discount of 2.24%. Okay, so we divide by 90 and we got a discount. Okay, so I think I'll shortly get your answers also. So it is a discount of 2.24. Okay, so now we will move on to understanding how the forward points are determined. Yeah. First, you have done it right. So you're getting 0.9. So what at discount minus 9 should not be there. When a discount, yeah, you can do that. If you say it is a discount, then you can say 2.24%. So that is right observation. So it was just for an explanation. Okay. So but you can always not use negative this thing when you're saying it is discount. Okay, so let's understand, how the forward points are determined. A little bit more about that. So number of basis points from the spot rate to arrive at the forward rate are forward points. So number of basis points from the spot rate to arrive at the forward rate are called forward points, or even they are called swap points. Okay, so the points are added to the spot rate when the currency is at premium. So when the currency is at premium, so we simply add, and we have done an example where the currency was at premium, the dollar was at premium compared to the rupee. Deducted from the spot points when the foreign currency is at discount to arrive at the forward rate. So whenever it is deducted when you find the foreign currency is at discount. Okay, so we'll understand. We'll do a question, some type of questions that come like that in the exam. So you should understand, whether the forward rates are at discount or at premium by simply looking at the quotation. So this is when the rates are quoted in a direct, method. But in case of an indirect rate quotation, the process will be exactly opposite. And this also will learn through exam questions which we'll be doing in our journey to understand this topic. So the forward points represent the interest rate differential between the two currencies. Now this is very important, and I'll be dwelling most of the time in today's lecture, or maybe some part in the next lecture on this concept. The forward points represents the interest rate differential between the two currencies. Okay. Now, a little bit we're just coming, but we will be talking more about the interest rate differentials. Now, let's give an example. Suppose in India, the rate of interest is 6%. Okay. And the rate of interest, say, is 2% in US. So the forward point will represent rate differential. That means 4%. So that means the US dollar will be, always be at a premium of 4%. If suppose the rate of interest today are 2 and 6% respectively for US and India. Okay. So we'll talk about why it happens and what is the logic behind it a little later. So forward points equivalent to pips. Forward points are equivalent to pips in the spot market. Okay, so we call it pips, we call it swap points, we call it margin. Okay. So let's take an example. If the spot exchange rate is, Great Britain pound 1 is equal to dollar 1.6000, 1.6010. So this is the quote in terms of 1 pound, British pound is equal to so many dollars. So if the outright forward points are 5 and 8, then we simply say then the outright forward exchange rate should be 1 Great Britain pound is equal to 1.6005 and 1.6018. So we are simply adding those bits, 5 and 8, to the last 4 decimal places and arriving at the forward rate. So the forward rate 1.6000 is the spot rate. We add 5 to it, so we get 1.6005 and 1.60110, which is the spot rate. We add the 8 points to it, so we get the forward rate for pound in terms of dollars. Okay, so that is pretty simple. So the currency which carries lower interest rate is always at premium versus the other currency. Now, just empirically or intuitively, we can understand this. Like in India, the rate of interest is always higher. Inflation is also higher. The interest rates are higher. In US, the inflation is low. Interest rates are low. Because of that, US always trades at premium. It should trade at a premium against India. Okay, it can. Of course, there can be small aberrations to that, but normally we'll find if you look at a 1-year forward rate, then we'll find that the dollar will be always at a premium. But only under very rare circumstances on the day-to-day fluctuations, sometimes the rupee can appreciate, sometimes the dollar appreciates, but overall the dollar is going and moving ahead always. Okay, so if you look back the quotation, say way back in 1940 or 50s, $1 is equal to 1 rupee, and today $1 is equal to 73 or 74 rupees. So the inflation in India has been higher, the interest rates are higher, so the dollar has been appreciating over so many years. So the currency which carries lower interest rate is always at a premium versus the other currency. So like, the dollar will be always at a premium compared to the rupee. If there is an aberration to this, arbitration opportunity arises. So if suppose that is not happening like this, there is an aberration to this, then arbitrage opportunity arises, which itself will push the prices to equilibrium. Suppose it happens that, it happens other way around, then, the arbitrage, players will come into the scene and they will trade, and, the equilibrium will arise. And we'll understand this more through an example very shortly. Okay, what does it mean? So they are quoted to an accuracy of 100 of the 1 point. So if Euro USD rates for spot and 90 days forward are 1.1323 and 1.1328, then we say the forward point is 5 because 1 pip or point is worth 0.001 in this quotation. So this is nothing new. We have already covered that. So let's talk about one question, okay, one MCQ. So please try to understand when is a foreign currency most likely trading at a forward premium? Okay, so read this question yourself. A, when the forward rate expressed in domestic currency is below the spot rate. When the forward rate expressed in foreign/domestic currency is in equilibrium. When the forward rate expressed in the domestic currency is above the spot rate. So when is a foreign currency most likely trading at a forward premium? So which is the right answer? A, B, or C? So please put your answers on the chat line so that I can understand. So this is a pretty simple one. When the forward rate expressed in domestic currency above the spot rate. So when is a foreign currency most likely trading at a forward premium? So which is the right choice? The right, what is arbitrage? Okay, wonderful. Sumit, this is a very good question. And I'll be answering this question in a great detail. So you will be enlightened with, what does arbitrage means. So you will, appreciate that when I cover that, which will be covered, I think, in a few minutes from now. So please answer this. So here the answer is the C, when the forward rate expressed in domestic currency is above the spot rate. Okay, fine. So, so now we come to a broken period forward rate. So this is, yet another very, very important concept, and the knowledge about this is must, because there are many questions, which will involve to understand this. Okay, so please be careful and absolutely be focused to understand what is a broken period forward rate. So the forward rate that is available in the interbank market cannot be applied as such for the customer transactions. the forward rate that is available in the interbank market. Now, what is interbank market? It's a wholesale market. Okay, it's the market between banks among themselves. Cannot be applied as such for the customer transaction. Because when, we as a customers go to the bank, we will, the interbank rates are not applicable to us. Okay, the merchant rates, which are called the customer rates, or the retail rates are applicable. Okay, the broken period concept becomes relevant in such situations. Okay, because the bank is not going to give us the dollars or any currency at the interbank rates. Okay, so we must know the broken period concept. The bank quotes swap points for 1 month end, 2 month end, and so on till 12 months. So generally, when the bank's interbank rates are quoted, so they are always given at a month end, 1 month, 2 month, 3 month, 4 months, 5 months, 6 months, and it goes up to 12 months. So there are 12 months quotes which are always available when we look at the interbank rates. But normally, when we require dollars, we can require on any date. We may require on, say, 5th of January 2021 or say 22nd of February. So since the rates are always at the month end, so how do we arrive at those rates? Okay, fine. So which way does it? However, sometimes the customer needs swap points for 2.5 months. Suppose I have to make a payment from today to 2.5 months from now. So I need the quote for that particular day, okay, or 45 days. Since the interbank rates are always a monthly quotes, so how do we arrive at? Okay? So here, the presumption is basically that the forward points grow uniformly throughout, and arithmetical proportionate for applicable rate is arrived at. So, this is a very important assumption. The forward points grow uniformly throughout, and arithmetical proportionate for the applicable date is arrived at. So, we'll soon understand what does it mean through a very simple question which we'll be solving. Okay, so if you have some kind of apprehensions, what is it written? So you will find it is simply a mathematical game. Okay? Fine. So let's understand, before we do that, let's understand what are interbank rates first of all. Okay, so then you'll understand why what we are doing. They are large standardized amounts with standardized due dates. So interbank rates are large amounts because it's a rate, the trade which is happening among the large banks. So it's a standard amount on a standardized dates. That is the end of January, end of February, like this. I said rates are always given at the month end. Okay, but the transactions are happening every day. Okay, so interbank rates are standardized, applicable for large, dealings, and it is always given at the month. So, however, in customer transactions, the amounts are not only smaller, but for odd amounts, but the due date could also be a non-standardized one. Because, it's not always that we are going to pay money, say on 31st of December or 31st of January, since the interbank rates are only given and rates are there for the month ends. So how do we, solve this, puzzle? Okay, if I have to pay a very small amount, for example, there can be an export bill of, euro 12,345.67. Okay, so this is in terms of interbank rate, a very small amount. So this money, I'm going to realize on 10th of January or say on an odd date like 23rd of February. Fine. So how to arrive at a rate on that particular date? Thus, the forward rate that is available in the interbank market cannot be applied as such for customer transactions because they are always given at a month end. So the broken period concept becomes relevant in such situations. Okay, so let's do a question to understand this concept. Okay, what does it mean? Okay, so let's say on April 3rd, 2016, bank quotes the following. Spot exchange rate is given as 66.2525. Okay, fine. Let me see if you have some. I've got some. Yeah. Okay. Suppose on April 3, 2016, the bank quotes the following. The spot rate is given. Okay. The bid and ask rates are given, and the 2-month swap points are given to you, which is 70 and 90. Okay. So in this question, we are given the spot exchange rate on April 3rd, 2016, and the swap points for 2 months and the swap points for 3 months. Okay. So in a spot transaction, delivery is made after 2 days. We know that the delivery and the payment happens after 2 days. Okay. Assume the spot date the spot date is always the date when the delivery or the transaction, the delivery is given and the payment is made, which is 5th of April 2016, which is exactly 2 days after the date which is mentioned above. So assume one swap point is 0.0001, 0.0001. Okay. So in rupee it is always like that. So you're required to calculate, ascertain the swap points for 2 months and 15 days. So that means basically we have to find out what is the swap points for 2 months and 15 days. Okay. Remember that proportionate thing which I talked about. So that means for 20th of June 2016, first I have to calculate what are the swap points for that particular date. Second, determine the foreign exchange rate for 20th June 2016. So on that very date, so I'll have the spot points, I'll have the spot rate, I'm going to simply add them up, but solving the second question. Compute the annual rate of premium or discount on US dollar on an average rate. Okay, mind you, it is written on an average rate, so we'll understand that. So swap points for 2 months and 15 days. So this is what we are supposed to calculate. Okay, so if you see on your screen, I'll do it on the board if required, but let's understand on a screen first. So swap points for 2 months, which is 70 is the bid point and ask is 90. So it is given to us. So this is given to us. Swap points for 3 months is also given to us, which is 160 and 186. So this is what is given in the question. So their swap point for 2 months is given, swap point for 3 months is given. So we are just simply going to, do a mathematical this thing, 160 minus 70. So we'll get swap points for 30 days. So for 60 and 90 days, it's already there on the screen. So we are calculating for 30 days by simply doing B minus A, which is 160 minus 70 and 186 minus 90. So we get swap points for 30 days. Okay. Then we get swap points for 15 days. We just simply make it half of it. So it's 45 and 48. So we are assuming the swap points move in, a proportionate way and they are uniform throughout, So we are assuming on the assumption. So swap points for 15 days will be 45 and 48 respectively. So which means swap points for 2.5 months would be 90 plus 45. So it's 115 and 96 plus 48, it will be 138. So now we have arrived the swap points for 2 months and 15 days. Okay, so the first question was to arrive at swap points for 2 months and 15 days. Now we are going to calculate the foreign exchange rate for 20th June 2016. So here it will be like this. Now we are given the spot rates are given to us, which is 66.2525 and ask rate is 67.5945. So we are going to simply add the swap points. Okay, so remember it is 115. So we will appropriately put a decimal place there because it is it's a 4 decimal code. So it will be 0.0115. Will be put under 66.255 and it will be 0.0138. Okay, divided and plus 67.5945. So we'll arrive at the quotation or the quote on 20th June 2016. So swap points were 115 and 138, but for adding to the spot rate, we just simply use the decimal at the right place to add it because it's a 4 decimal places point. So we are going to put a 0.0 and then add 115 to make it in a correct way of arriving at the foreign exchange rate. Okay, I hope you have understood. If you have understood this concept, so please say yes on the chat line so that I feel that you have understood this. Okay, otherwise I'll explain it again. Now the third part was basically to calculate the annual rate of premium. So here what I have done is I've taken the bid rate, the spot rate which was given in the question, and then the rate which I arrived just now on 20th of June. So it is 66.264440. So then I'm just going to put a premium here, which is 115, 1138. So I'm just reproducing the premium which I calculated in my last slide. And then I'm just simply adding these two quotes and then calculating the average of it. Okay, because in the question it's written what is the forward premium on the average quotation. So now we know the swap points 150 and the average quotation is this, and this is for 2.5 months. So I'll say 1.0015 divided by 66.25 into, I'm going to calculate the annualized premium. Okay, so 12 divided by 12 months divided by 2.5 months into 100. So I get 0.008% premium on the bid rate, and similarly 0.0980% on the ask. Okay, so this is pretty simple. You have to calculate the premium on the bid and ask. So first I did was I took the spot rate, then I added the rate on 20th of June to it. Okay, so I got a figure 132.5165, and then I calculated the average. If you look at the question, I'll take you back to the question now so that you can understand why I'm doing it. You are required to focus on the third. Compute the annual rate of premium / discount of US dollar on INR on an average rate. Okay, so this is given in the question, so that's why I'm doing it. Okay, fine. So here I just added the two quotations, the quotation at the beginning and the quotation after 2.5 months, and I came at 132. Then I did the average of it. Okay, so the average rate in the last 2.5 months, I presume it's 66.25, and the swap points are 115. So which means there's a premium of that. I hope you have followed. If you have followed, understood, you're very good. Yeah, it is always up to 4 decimal places. So yeah, it should be, it should always be up to 4 decimal places points. What you have said is absolutely right. When you do in practice, when you look at the quotes in the foreign currency markets, you'll find it up to 4 decimal places. Okay, but in your question, it can be even given 2 decimal places. Okay, fine. But in practice, it's always 4 decimal places. So now let's go and understand, a little bit more about. Now we are moving towards a very interesting part of our journey to understand what are interbank rates, and we will do some questions which are very, very important, which are some small parts of your bigger questions. Okay, so this is also doing some basics. So interbank rates. So interbank rates are wholesale rates. Remember, these are wholesale rates, not applicable to the customers. Okay, as we have seen that we have to arrive at those rates based on the calculation we did in the last question, which are applicable to transactions among banks. So interbank rates are applicable only to the transactions among banks and not between the banks and the customers. So forward rate that is available in the interbank market cannot be applied as such for customer transactions. Okay, so this is a very important point. The rate which are available in the interbank market cannot be applied as such for customer transactions. Okay, so so just a little bit more about the interbank market. The forex interbank market is a wholesale currency arena. Okay, so interbank market is actually a wholesale currency arena. The interbank market is a global network utilized by financial institutions to trade currencies between themselves. And why they do it, we'll understand this more in detail. It's a very important thing. The most interbank trading is proprietary, meaning that it takes place on behalf of banks' own accounts, and also it is done by banks on behalf of large customers. So interbank market is a wholesale arena. It's a globalized network of financial institutions whenever they trade currencies among themselves. So the rates quoted in these markets are called interbank rates. And most of the time they're doing the trading for themselves. Okay, and it is done on behalf of large customers also. So now, okay, so please focus. This is a very, very important part of our learning now. So if you understand this today, then you will not make any problem in your questions. So you'll be able to solve your question very easily. If the spot rate for US dollar is 72 rupees, okay, let's say, without any decimal places, we are just putting it just to make the things so that you can understand. If the forward margin for 2 months is 10 paisa, which is a premium, okay. If it is, forward margin is for 2 months is 10 paisa, then we say that the forward rate is calculated as 72.10 per US dollar. Okay. Here we are putting up to, I'm not even putting any decimal places, just to explain the concept. Okay. So the spot rate is 72, or we can say it is 72.000. So zeros are ignored. So if the forward margin for 2 months is 10 paisa, which is a premium, then we say that the forward rate is 72.10. So far, so good, and it is easy. But now, suppose an importer comes to the bank. So this is actually the interbank rate. Okay? Now, thus a bank wishes to keep a margin of say 3 paisa. It will quote a rate of 72.13 for an importer. Okay. Now, suppose if there is an importer, what he wants to do, he wants to buy dollars. So he approaches the bank. Now, bank says that the interbank rate today is 72.10. So this is the rate at which they are going to buy from the other banks in the interbank market. But if they are going to sell to you, they will sell you at 72.13. Okay. So which is 72.13 is basically the ask rate. Okay. If you look at the bid and ask rates, so this will become an ask rate. So in the ask rate, we always add the margin to arrive at the merchant rate or the customer rate. But if it is an exporter, okay, if an exporter comes to you and a quote rate of 72.07 for an exporter. So that means if I'm an exporter, I have got dollars with me. If I go to the bank and say that I want to sell my dollars, so they will look at the interbank rate and they'll find the rate is 72.10. So that means they will take the dollars from me and sell in the interbank market at 72.10. So because they want to earn margin, so they say, okay, we'll buy from you at 72.07. Okay. So this is their bid rate. So when you look at the bid rate, the margin is always reduced to arrive at the merchant rate. Okay. So for an exporter, they are going to, give him less so that when they dispose of this dollar in the interbank market, so they'll make a 3 paisa gain. So remember this. This is very, very important. Most times the students don't understand this. So this is, a base forming situation now. So if the rate is given and the margin is given, then the rate for the importer will be always higher. For exporter, it will be less compared to the interbank market. Okay, because of the explanation which I have given, the 72.13 will become the ask rate. Okay, so to arrive at the ask rate, we must, add the margin. Okay, because the importer, they will, give importer the dollar at 72.13 because they themselves are acquiring in the interbank market at 72.10. So if they sell it at 72.10, then they are not going to make any profit. So when a person comes to them and says, I want to buy dollars from you, so they'll say, okay, hang on, the rate is 72.10 plus 3 paisa. So it is 72.1. So to the ask rate, we always add. But when you look at, suppose you are an exporter, suppose I have got dollars with me, I go to the bank and I want to sell the dollars to the bank. So when I sell the dollars to the bank, they are going to dispose of those dollars at 72.10 in the interbank market. So they are not going to take the dollars at 72.10 from me. They are going to take at 72.07, which will be 3 paisa less. This is just an example, okay? It can be 3 paisa, it can be 2 paisa, whatever. So if they take the dollars from me as an exporter, they will give me 72.707 and they will sell it in the interbank market at 72.10, bank making a 3 paisa profit. Okay, fine. The margin depends upon which factors. Okay, so that's a very good question, but just wait for a while. Okay. It will all depend upon, the margins will depend upon basically the liquidity of the currency pair. If the currency pair is very often being traded, there's a lot of volumes which are happening. Okay, there's a lot of sale and purchase of dollar happening in India. The margins will get reduced because the bank is going to make money out of the volumes. Okay, so they earn less because if you approach to various banks, so people, this is a competitive market. So if crores of rupees are being converted to dollars or dollars are converted into rupees, then the margin will drop. But if there is a currency which is not being traded very high, which is very rarely being traded, then the banks will charge a very high margin because then they can't. They have to make profits. Okay, so if the volume is very high, the margins will go down. If the volumes of the currency is very less, the margins will go up. So it will depend upon what kind of currency. Generally, with the dollar, the margins are always low. But we look at currencies like, for example, I'm just giving a New Zealand dollar, okay, which is a very small part of the total overall volumes which are happening in India. So the margin will be higher because the bank would like to make profits on small margins. So they have to deal, and there's always a transaction cost involved. So they to take care of that. So the rates will be, the margins will be higher or lower depending upon what kind. So it depends on bank to bank, but it is actually market driven. So Sumit Jain, it is a market driven something like this. Okay, it's a market driven thing. The banks charge, they have their, their sweet bill to charge margin, but it will depend upon the market. Okay, it will depend upon, how competitive the market, so the margins will be pushed down if, there are a lot of banks and a lot of customers dealing. Okay, so that's a normal phenomenon which we observe in demand and supply game. Okay. So exchange rates now, margin depends on the bank to bank. Yeah. So margin is same for bid and ask. Yeah, it's same generally. It's same. Normally it's same. Okay, it can be different, but normally it's same. Now let's, we'll do some questions on that. What we have learned. So before we do that, exchange rate applicable for transaction between two banks, forex dealers, is known as interbank rate. Normally, interbank rates are quoted up to 4 digits after decimal. So please, this is what you are asking. Normally, interbank rates are quoted up to 4 digits after decimal. The rates are rounded to 4 decimals in multiples of 0.0025. So this is very important. Rates are rounded up to 4 decimals in multiples of 0.00. So there is always a rounding off which takes place. Okay. So rates will be, last 2 digits will be always either 25 or 50 or 75 or 00. So it can't be an odd amount. Okay. So always, the rates when they are presented to the customers, they will be rounded off. Of course, rate will be always, it can be in the odd numbers, but when their actual transaction happens, they are generally rounded off to 0025. So now this is very important. Please focus. The interbank rates, we have the bid rate and the ask rate. Deduct margin from the buying rate and add a margin to the selling rate. So this is logic which I just explained. In the bid rate, what you are an exporter. You're the person who's going to the bank and selling your, foreign currency, either it's dollar or euros, whatever. So the bank is going to reduce the margin, okay, deduct the margin, because they want to make money on that, because they will not give you they're not going to take your dollars at the interbank rates. So they are going to give you a little less than that. Similarly, if you're going to buy dollars from the bank, then you look at the ask rate. Okay, so they are going to add margin to it. Okay, because when they'll sell to you, their cost will be the interbank rate. So they are going to add margin to it and present that rate to you. So this is the interbank market minus the margin is called the merchant. So it is called the merchant rate. Okay. So interbank bid rate minus the margin is the merchant bid rate. And interbank ask rate plus the margin is the merchant ask rate. And this is a very, very important. So most of the time, students always ask this question. Okay. And I hope I have explained it in a very simple language so that you don't make a mistake. Okay. So you must only remember this while you understand the logic, that in case of bid, I'm going to minus. In case of ask, I'm going to add the margin. So then it becomes a little mathematical game when you're solving the questions. Okay. So again, once more. So, interbank, I say always, large banks, when the banks deal among themselves. So when you go to a bank, which is your bank, which I say it's a small bank. Okay. So where he's going to quote you the merchant bid rate because he's getting the quote from the large banks, which is the interbank. Okay. So exporter selling dollar to his bank at interbank rate minus the margin, and his banker selling the same dollar at the interbank rate and thus gaining a margin. So what normally happens is when you go to a bank with the dollars or with any currency and you want to dispose of them, you want to sell them off as a customer, you have received as an export proceeds. So bank is going to give you a rate which is lower than the interbank rate because he's going to take the dollars from you and immediately he's going to sell it in the interbank market, because if they don't take any exposure on the hand, normally the bank would like to make a profit immediately. Okay, so they will immediately go and dispose of the dollars or any currency in the interbank market and making a gain. Okay, now the gain and the margin will all depend upon the competition, how many banks, how many people who are actually into the trade. And similarly, an importer buying dollar from his banker at the interbank rate plus the margin and the banker buying the dollar at the interbank rate and thus gaining the margin. So, what is happening is when a person comes to the bank and says, I want dollars, okay, I'm an importer, I have to make a dollar payment to someone. So they are going to add a margin to the interbank rate. Okay, so that means first they will buy these dollars from the large interbank market and then give it to you at a rate by adding their margin. Okay, and making a gain. I hope this you have understood. If you have understood this concept, please say yes on the chat line. Okay, so we'll be doing a question now. Okay. Okay, so we are moving towards a question. Okay, so which is very important because these are the sub parts of most of the question in your exams, and you will never make a mistake on such kind of questions, and you understand this concept. Okay, so if you have understood, please tell me yes. If you have not, so please say no, so that I can move forward. Okay. Okay. So I'm awaiting for your reply. In the meantime, I'll just look at an example. So quotation for US dollar in the interbank market is as follows. The spot rate is given to you, which is 75.2900 oblique 2975 per dollar. Exchange margin is 0.10%. Okay, here the margin is given in terms of percentage. Determine the spot merchant rate from the above information. Rates to be rounded up to 4 decimal in multiples of 0.00525. So this is a question which will be most often it will be coming in your exam, but this will be the sub part of the question. Okay, so first let's focus on this part so that it will help you to solve a bigger question in your exam. So this will be one part of the question of a large question which will come in your exam. So let's look at the question. Yeah. So cost of, yes, clear, wonderful. Ambika and cost of healthcare. So again, I hope you have also understood. So let's look at this question again. Quotation for US dollar in the interbank market is as follows. Okay. Spot rate is 75.2900 oblique 2975 per dollar. So this is the same question I put it in a more bold fashion. Exchange margin is 0.1%. Determine the spot merchant rate from the above information. Rates rounded to 4 decimal in multiples of 0.0025. Okay, so just have a look at this question. Okay, so we have to calculate the merchant rates from the above information. Exchange margin is 0.10%. The spot rate is given, and then we have to do the rounding off. Okay, so let's understand this. Now, the interbank rate which is given to us is 75.29. So $1 US is equal to 75.2900, which is the bid rate, and the ask rate is 75.2975. Okay. So first question, I'm just going to do it on this thing, and then I'm going to move to the board and solve the second question. So exchange margin is 0.1%. So we have to deduct margin. Add margin in case of the ask rate. So the margin is say, so it is 0.1. So what I do is 75.2900 into 0.1%. So I get 7529. Okay. Similarly, I take 75.2975 into 0.1%. I'm doing our calculator at the same time. So I get 0.0752975. Okay. So this is what we have got. So I'm now going to just simply add to calculate the merchant rates. So these are the rates which will be applicable to the retail customers. So bid and ask. Now we have to get to do rounding off. So how the rounding off is done? Like this. So the rate will be 75.2147 will become 75.2150, and 75.3728 will become 75.3725. I hope you have understood. If you have understood, say yes on the chat line so that I can just do the second question on the board, and then one question you will be doing. Okay, fine. Or when I do the question on the board, on the same time, I expect to solve it and put the answer. We are 72.2147. Yeah. So these have to be needs to be rounded off. So great. So you, Ambika has done it. Wonderful. And others are also, I think, understanding it. So let's do a question. So I just, stop sharing this. So first look at the question, okay? So that I can go to the board and, explain that. So quotation for US dollar in interbank market is as follows. Spot rate is 62.66. This is a pretty old quotation. 62.72 is the ask rate. Exchange margin is 0.1%. Determine the spot merchant rate from the above. So question is exactly the same, okay? But still, I like to, put it on a I hope you can see the screen now. So the question here is that the spot rate is given to you. I hope you can see myself. Yeah, it's there. So the spot rate is given. Is given as rupees 62.6800 and 62.7200. So these are the rates given. So this is, $1 is equal to this. Okay, so this is the rate which is given. And exchange margin is 0.10%. Okay, fine. So we have to determine the spot merchant rates. And so we will be doing the margin, will be doing minus, and we'll be adding the margin here. Okay, so if I calculate the margin, okay, so I expect to please solve this question while I solve it on the board. So 62.68 into 0.1%. So I get 0.6268. Okay. And here I get 0.6272. Fine. So sorry. 0.0. Okay. Fine. So the merchant rates will be this minus this. So I will get 62.6173. Okay. And this I will get as 62.7827. Okay. So this is what I'll be getting. Fine. So now I have to round it off. Okay. So rates rounded off to 4 decimal places. So which will be 0.0025. Okay, rounding off. So 62.6175. Okay. And here I'll get 62. So this is basically the rounding off. 62.7825. Okay. So this is what I get. So 62.7825
7825 and 62.27. Wonderful. I think Ambika has got it, and others I believe have also got it. No, it can't be rounded off to 75.2145. It has to be in multiples of, it can be, 0.25, 0.50, or 00 or 0.75. Okay. So when we are doing the rounding off, it has to be in a pattern. It can be 0.0025 or 0.00. It can be 76. Like, this case, it is 75. The last two decimal places is 62.6175. So either the last two digits will be, either 25, 50, 75 or 00. It can't be 45. Okay, fine. So let me just share the slides again. Okay, so I'll be just sharing the slides now. I have so this we have done so far. So now this is what you are supposed to do it yourself. Okay. So this is an exercise, I would like that you should do it yourself and give me the answers. So I'm just giving you a couple of minutes. Okay. So please do it. So quotation for US dollar in interbank market is as follows. I hope you can see the screen now. Yeah. So quotation for US dollar in interbank market is as follows. Spot rate is 73.58 and 73.62. Exchange margin is 0.12%. Determine the spot merchant rates from the above information rounded off to 4 decimal places. So please do this exercise. So please try to solve this question. I'll give you 1 more minute to do, then I'll put the answers. Okay, so I'm just sharing the answers with you now, and you can just check your answers while you post it on the, and if you have any questions, so you can ask me. This is the answer for the question. So the rates which I have arrived at is the merchant rate is the bid rate is 73.4917 and 73.7083. Yeah. Yeah, Sumit, you have got it right, absolutely right, bang on. But here, actually, you have rounded off the first one is 0, 0. Because it is 17, so this will go to 25, okay, and not to 0, 0. Because if you see the number 25 is nearer to 17, and you are otherwise reducing 17 pips. So here you are adding just 8 pips. So you should actually add 8 pips rather than reduce 17 pips. Okay, so that's why the answer is 73.4990 is not correct. Okay, it should be 73.4925. Similarly, 73.7083. So by adding 17 pips to it, you get 73. But if you have to reduce, to 75, so yeah, I think 75 should be also a right answer. Yeah, fine. So so you can even put the answer as 73.7075. Ideally that would be the right answer. Okay. So I make a small correction here. It should be 73.7075 because of the fact that if you add, it will be 17 points. It will reduce. You will be just making a 3 plus 5, 8 points. So this should be read as 75. So I'm just making a correction here. So what Sumit has understood is absolutely right. Sumit, what you have done is absolutely right. It should be 73.75. Okay, because this 75 is much nearer to the number. Okay, fine. So this is what you have done is absolutely right. So really great. I mean, Sumit, you have understood it, I think, now. Okay, so let's now do. Let's move on to exchange rate determination. Okay. Okay, so this I have explained to it. Yeah, definitely. No, this because since I have done it now, so I think I have corrected myself. Okay, fine. So exchange rate determination. So let's move on to. So exchange rates can be for a forward delivery, can be for a spot or a forward delivery. Okay, so you get rates either for the spot rates or for the forward rates. The spot rate is a rate paid for delivery within 2 business days after the day the transaction takes place. The spot rate is a rate for delivery within 2 business days after the day the transaction takes place. Okay. If the rate is quoted for delivery of a foreign currency at some future date, it is called the forward rate. Okay. So this is pretty simple. If the forward rate, the exchange rate is established at the time of the contract, though the payment and delivery not required until maturity. So in the forward rate, the exchange rate is established at the time of the contract. Okay, though the payment and delivery are not required until maturity. So that means the rate is determined today, but actual delivery and the payment happens on that future date. Or it can be 1 month, it can be 2 months, or it can be 3 months. The forward rates are usually quoted for fixed periods of 30, 60, 90, or 180 days from the day of the contract. So the forward rates are usually given for 30 days, 60 days, 90 days, or 120 days, 180 days. So this we have already covered a little bit in earlier part of our lecture. So the forward exchange rate occurs when the buyer and sellers of the currencies agree to deliver a currency at some future date. Okay, they agree to transact a specific amount of currency at a specific rate at a future date. So these are all the same things said in different ways. So the forward exchange rate is set and agreed by the parties and remains fixed for the contract period, regardless of the fluctuations in the spot exchange rates in future. So that means the rate which is fixed today for the forward, future date is remains same throughout the period. Okay, the rate is fixed today itself, and you will get your currency at the rate, same rate which you have fixed today at a future date. Okay. Okay. So the forward exchange contract implies a forward delivery at a specified future date of one currency for a specified amount of another currency. The exchange rate is agreed today, though the actual transaction of buying and selling will take place on the specified date only. So here, I will just have a small break and we will meet after exactly 5 minutes. So we have a break now. Okay, so we will come after Okay, so let's start. So, Sumit Jain, the question is there expiry like derivatives? Now, when we do futures and options, like in forwards market, there are no, expiry. Okay. But in futures and options, there is an expiry. Okay. Fine. So we'll understand that about the expiry also little later. So your question is good, but at the moment it doesn't have any relevance at the moment. But definitely there is an expiry in derivatives like the futures and options because they are exchange traded, instruments, derivatives. Whereas forward is an OTC basically instrument, so there is no expiry. The expiry is decided by you basically the day when you want your payment or when you have to make or you have to receive, the payment. So that is the day on which you fix with the bank. So that is the last date or the expiry date. So kindly ask the concerned person to upload the PPT of this class today itself. The last class slides were uploaded late. So it will be done today itself, okay? Don't worry. Diksha, I'll be doing it, I'll be sending, because, while I'm making a presentation, I always see whether there is some kind of, error or not while presenting. So the moment today, we cover up that this thing lecture, I will, give the slides to the concerned person in the Institute of Chartered Accountants, so they will, relate back to you. So, so let's understand now. Let's begin now. I think you are able to see the screen now. Okay. So let me just check. Yeah. So let me just share the screen and start further. Okay. Okay. So currency forward contract. So let's begin a little bit more. The currency forward is a binding contract in a foreign exchange market that locks the exchange rate for the purchase or sale of a currency on a future date. So basically, it's a binding contract on both the parties. Basically, it's always the customer and the bank, or the customer or a broker. Okay, so that locks the exchange rate for the purchase or sale of currency on a future date. So basically, today we decide about what is going to be the rate which is going to be charged in future, say after 1 month or 2 months, and that rate remains the same. And at the time it comes, you get your your foreign currency at that rate. Either you pay or you have to receive your money in the home currency when you sell that the foreign currency on future date. Okay. So currency forward is essentially a customizable hedging tool. So it's a hedging tool basically. It helps us to hedge because a person would like to take a forward contract because he doesn't want to be exposed to the fluctuation in the foreign currency. So it's a hedging tool and it's a customizable hedging tool because here you can decide about the amount in terms of foreign currency. You can be an odd amount or it can be it can be on an odd date. So everything can be customized. It can be $1 million. It can be in small amounts and does not involve any upfront margin payment. Like in case of a stock market, when we understand about the futures, because currently we are understanding the forward contract, when we understand the futures contract, which is exchange managed, so they are not customized hedging tools. Though they are hedging tools, but they are not customized. They are standard ones, okay? And there is a margin involved in entering into a trade in the futures market. So in the forward market, there is no margin, and they are customizable. You can do it the way you want. You can fix up a date. You can have an odd date, say 3rd of January. Fine. But in futures, there's always a way around to doing that, but that we'll learn later. But they are not, they're standard amount. So they are in multiple of say $1,000 or say, if you want to take a position, it will be in multiples. If you're taking a position in dollars, it will be always in multiples of $1,000 and not less than that. Okay. Fine. So the major benefit of the currency forward is that the terms are not standardized and can be tailored to a particular amount for any maturity or a delivery, unlike exchange traded currency futures. So that is what I was trying to tell, that you can tailor make your own forward contract depending upon your need. But whereas when you are using the same hedging mechanism through a futures contract, then you have to live with the standardized contracts of the exchange. Okay, so a currency forward in that way is a very flexible
hedging tool compared to a futures one. Okay, but there are advantages and disadvantages of both. Okay, so we learn that as we understand the whole topic. So forward contracts are usually offered by commercial banks. Okay, so you have to go to a commercial bank or for getting a forward contract. You don't have to go to a stock market, right? So this is a contract between you and the bank. Okay. Banks offer the important customers forward contracts as a part of their business. So all the banks, big banks, big branches, whenever you approach them, they'll say that this product is available with them. So you can take a forward contract. If you're a businessman, if you want to take a hedge on your money which you're going to pay in a foreign currency or going to receive, so you can always enter into a forward contract by way of forward contract by approaching your banks. So banks will generally offer this product. It enables firms to engage in international trade with a limited exposure to foreign currency risk. So basically, by entering into a forward contract, you are limiting your foreign currency risk. Now, the risk can be both ways. You can make money or you can lose money if the foreign currency moves up or down. Sometimes it goes in your favor, sometimes it goes against you. So the businessmen particularly don't like if they lose money on account of foreign currency. So they would not like to be disturbed because of all these pluses and minuses because of the foreign currency risk, which is arising because of the movement of foreign exchange fluctuation. So they will generally go and hedge themselves, okay? Because they know this is the amount of profit they are going to make on account of margins which they have on their businesses. So they would not be bothered about making some extra gain or some loss through the foreign currency fluctuations. So it gives a peace of mind to the persons who hedge themselves. So, this is about the foreign exchange rates. So now we'll move to the third part of the slide. Okay, so which is let me just open that. I'll be giving all these slides today itself. Okay, so by today, after the class, these slides will be available to you very shortly. Okay. Fine. So let's go to the part 3 of our lecture. Okay. So let's understand exchange rate determination. So this is also a very, very important and very interesting part of our journey in understanding the foreign exchange rates and foreign exchange hedging techniques. So theories of exchange rate determination. Okay. How the exchange rate getting determined, what are the various theories on which the exchange rates, they say how the rates are fixed. Okay. So the old theory, which is now no more applicable, is the first theory which came in the world was called the mint parity theory, which was based on gold. Okay, the gold standard, what you might have heard, in some kind of discussions. So a gold price in Britain, was say 20 pounds per ounce. And US, it is say $80 per ounce. Suppose this is the rate of the gold in the two countries. Then we say that 1 pound is equal to $4. So the gold decided the exchange rates. This was a theory because gold was considered to be a very precious commodity, and still it is. So gold prices were determining the exchange rates, and that is in history now. So gold price in Britain was $20 an ounce, say a particular time, and in US it was 80 per ounce. So then we say on that basis of gold theory, 1 pound will be equal to $4. So this is what the gold theory says. Okay, the rates are hypothetical here. Now the second theory, which is based on the purchasing power parity theory. Okay, based on basically the interest rate in the two countries. So if the price of a computer is $500 in New York, and the same computer, exactly the same computer, is available at 2,500 Hong Kong dollar in Hong Kong. So then we say that $1 is equal to 5 Hong Kong dollars. Okay. So this is called the purchasing power parity theory. So this is based on the inflation differentials between the two countries. Okay. So we look at how much it costs a same commodity in another country
and then try to work out what should be the exchange rates. So in this case, $1 is equal to 5 Hong Kong dollar based on the price of the purchasing price of a computer, the same computer. Okay, it can't be a different one, but it has to be same. Then the third theory is called the International Fisher Effect theory, which is based on present and future risk-free nominal interest rates. Okay, so this is a very important theory, which is based on the present and the future risk-free nominal interest rates. Okay, and then of course the advanced theory, which is called the interest rate parity theory, which is more relevant and talked about much in detail, is that it says there is a strong relationship between interest rate and movement in currency values. So let's take an example. Suppose in US the rate of interest is say 2%, okay, and India it is say 6% per annum. So the differential is 4%. Okay. Suppose the spot rate say of dollar is 70 rupees per dollar. So 1 year forward rate should be the 70 rupees multiplied by 4%. So 70 into 1.04. So the forward rate should be ideally be 72.80 per dollar. So this is what the interest parity theory says. Okay, fine. So the rate can be a little bit different here and there in actual market conditions, but the interest parity theory says that the interest rate is 2% in US and India it is 4%. Now interest rates are again based on basically the inflation rates prevailing in the country. If the inflation rate is higher, the interest rate will be also higher, and the inflation rate is low, then the interest rate will be also low. And in US, since the inflation is very low, the interest rate is 2%. In India, the inflation is comparatively higher compared to US. So we have a 6% interest rate. Currently, we're talking about, okay. Or it's just a hypothetical case where if this is the interest rate, then the spot rate is 70 today, then the dollar should be available at a premium, okay, by 4%, and it should be trading at 72.8. That means if you look at a forward rate today, then we'll find that the rate is 72.80 1 year forward, based on the interest rate differential theory. And this is very, very important, the important theory, okay? And most of the time in your exams, there are a lot of questions which are, hovering around this concept. So we will just keep a tab on that. So what is interest rate parity theory? So it's very important. So we'll dwell some more time on it, okay? So interest rate parity theory is a theory which states that the size of the forward premium or discount should be equal to the interest rate differential between the two countries of a concern. Okay. So that means the interest rate parity theory says that the size of the forward premium or discount should be equal to interest rate differential between the two countries. Okay. So if a 1 year interest rate in US is 2%, and that in India is 6%, the US should trade at a 4% premium against the rupee. Fine. And so this is what the interest parity theory says, because generally when the inflation is high, the rates of interest are high, so it will push up the prices of the commodities, and the currency which is having a lower interest rate as well as lower inflation will tend to be be trading at a premium, because the goods will become costlier in say a country like India. So just to keep the US and India at par, the exchange rate will also go up, so that the commodities in general are priced the same. It will offset any increase in the price in Indian commodity, so that it will cost exactly the same in US if the rupee depreciates by say 4% or the dollar appreciates by 4%. Okay, it will keep everything at par. Now, so please repeat purchasing power parity. Okay, I'll repeat that. Okay, I'll just go back and let me finish this a bit, and I'll come back to the purchasing power parity theory. When the interest parity theory exists, the covered interest arbitrage means the foreign exchange risk is covered is not feasible. So this is very, very important. When the interest rate parity exists, that means if in this example, if US dollar is trading at a 4% premium, the forward rate is 4% higher than today, the spot rate, then there is no covered interest arbitrage. Now you were asking what is arbitrage. So it's a time then to understand what is arbitrage. Okay. So so the covered interest arbitrage is not feasible if the interest parity theory holds in practical. So in real life, if the interest rate theory is prevailing, that means the forward rates are exactly matching with the interest rate differential, then there will be no arbitrage possible. Okay, and we call it covered interest arbitrage. So covered interest arbitrage, if you look at the bottom of the table of the slide, you will find covered interest arbitrage is a practice of using favorable interest rate differentials to invest in higher yielding currency. Okay, and hedging the exchange rate through a forward currency contract. Okay, so there are a couple of steps involved here. So suppose if now India it is 2%, the rate of interest is say 6% in India, and US it is 2%. Okay, so it will actually people in America will like to invest in Indian markets, into Indian debt market, because it is giving 6%, wherein in their own country they're getting only 2% interest. But what will happen if they invest in India? While they take out the money after 1 year, by making 4% in India, they will lose exactly 4% in terms of the dollar appreciation. So they're not going to make any gain. Fine. But if the interest parity theory is not there in practice, then the covered interest arbitrage will come into play. Okay. Because any interest rate advantage in the foreign country will offset by the discount on the forward rate. So this I told you that because there is an interest rate advantage in India, because the interest rate is high, so there will be tend to flow of dollars into India. Because in India you get 6% as compared to US it is 2%. But you will find that the forward rate has moved up by 4%. So that means after 1 year, if you're taking back you're converting your dollar, which you brought in India, and converting them back into dollar. You brought dollars in India, converted your dollar into rupees, and invested at 6%. Now after 1 year, you are converting back your money, which is Indian rupees, into dollars, and taking back, you will find that you lost 4%. So you have gained nothing. Okay, so that's why we say that the interest rate theory is not arbitrage will not be there. Okay. So thus the act of covered interest arbitrage would generate a return that is no higher than what should be generated by a domestic investment. Even if you will take a forward contract, when you bring money in India from abroad, say US dollars, and you have brought it for 1 year and you are putting money in a debt market and earning 6%. So you like to book your forward contract after 1 year so that you can take your money at the rate which is available today, okay, to hedge yourself. You will find that you are losing 4%. So you are not going to do a covered interest arbitrage, because if you cover your contract today, you find that you're not making any money. Whether you put money in US or in America, the returns are same, because you get a 4% differential, but that gets wiped off because of the forward rate. You find the dollar is available at a premium, or rupee has depreciated. So you will lose that 4% because of rupee depreciation, and you will not make a gain. Okay. So we'll understand this arbitrage through an example, okay, a little more. So, but before that, there's a question that what is, Sumijan saying, what is purchasing power parity? Just to address that, we go back to it. Now, purchasing power parity theory. Now it says, if the price of computer is $500 in New York, suppose if you want to buy a computer, okay, of a particular brand for a particular, specs or specifications are same. So if the computer is $500 in America, but if the same computer with the same specs is available at 2,500 Hong Kong dollars in Hong Kong, okay, fine. So that means something is costing $500 in America, and the same thing is costing 2,500 in Hong Kong because of the interest rate differentials. Okay? Because if then we say that the $1 is equal to 5 Hong Kong dollars. Because when you travel abroad, you will find, the rates are different. Okay? The same thing which a bread in India, costs about, say, 35 rupees or 30 rupees. The same bread will be available, say, for $2 in America. Okay. So because of the various inflation rates and various, this thing, so the rates can be different. So in purchasing parity theory was based on this concept. So coming back to, interest arbitrage. So it means that the less interest rates currency would be at premium. Yes, exactly. So Vincent, what you are saying is absolutely right. The currency which is trading, which is having a lower interest rate or a lower inflation rate, will always be trading at, should be trading at a premium. But this is, I mean, a concept. But in actual, when you look at the rates, you will find for a while there can be a different, I mean, it depends upon, the demand and supply of the currency. Sometimes you find a lot of money is flowing in India, into the Indian stock markets. So what happens in those days, the rupee is going to appreciate because, people are converting their dollars into rupees and investing in India. So in that particular period, you will find rupee is appreciating when there's a lot of money coming through FDI and FII. But the moment it becomes a normal situation, we'll find the rupee, again leading to a kind of a journey. The dollar is always going ahead with a premium. Okay, so there can be, some kind of fluctuation because the current demand and supply of dollar and rupee can change the equations for a while, but the interest rate differential and interest rate differentials or inflation differential will actually prevail in the market over a long period of time. Okay. So now there is another MCQ. According to the interest parity condition, if the domestic interest rate is 12% and the foreign interest rate is 10%, then the choices are the expected appreciation of foreign currency must be 4%. This is an MCQ, okay? So please try to choose the right answer. The expected appreciation of the foreign currency must be 2%. The expected depreciation of the foreign currency must be 2%. The expected depreciation of the foreign currency must be 4%. So what is the right choice? According to interest parity theory, if the domestic interest rate is 12% and the foreign interest rate is 10%, then, so what is the right choice? A, B, C, D. So you have to choose the right answer. And the right answer is B. The expected appreciation of foreign currency must be 2%. So this is what should be the right answer. Okay. So B is the right choice here. And so now, we will be covering covered interest arbitrage in detail so that you understand what is arbitrage. So somebody asked me about, what is arbitrage. So it's a time to understand what is arbitrage. Now, who asked this question, arbitrage? Let me just check. Okay. Sumit has asked the question, what is arbitrage? So now it's a time, everyone to understand what is arbitrage. Covered interest arbitrage. So please understand this, understanding of this will actually make you to understand the foreign exchange markets much deeper and much clearer. So covered interest arbitrage has an advantage as there is an incentive to invest in a higher interest currency to the point where the discount of that currency in the forward market is less than the interest rate differential. What does it mean? So covered interest arbitrage has an advantage. So when you will be doing a covered interest arbitrage, now the arbitrage guys will, they look at the list price. They always look at the, where is something available cheap. So the covered interest rate arbitrage has an advantage. When it has an advantage, when there is an incentive to invest in a higher interest currency, to the, now like India, we have a higher interest rate currency, okay, to the point where the discount of that currency in the forward market is less than the interest rate differential. So that means if the rupee has not depreciated to the extent of say 4% in the example which we took earlier, okay, it has only depreciated by 3%, then it will be always, you will make a gain by, investing in India, borrowing in US dollars and investing in India. Okay. So if the discount is, not to the extent of 4%, the example where, India is 6% and America is 2%. So India should be trading at a discount of 4%. If it is not that the case in the forward market, then the arbitrage opportunity will exist. So I'll explain this through an example also. So just stay with me. Now, other way around, if the discount on the forward market of the currency with higher interest rate becomes larger than the interest rate differential, then it pays to invest in the lower interest rate currency and take advantage of the excessive forward premium on this currency. Now, this is the second case, which is called the reverse arbitrage. If the forward premium reflects a very excessive, interest rate differential, it is more than that. For example, if the interest rate in India is 6% and America is 2%, so ideally speaking, the forward premium should be equal to 4%. But suppose it is 5% or 4.5%. So in that case, it is always makes sense to borrow in India at 6% and invest abroad at 2%. You will make a profit of that. So let's understand this through an example. So what these two boxes are very, very important. I'll revisit these two boxes again once I'm through with my example. So look at this example. If the 1-year interest rate in US is 2% and that in India it's 6%, the US dollar should trade at a 4% premium against the rupee. Okay, this is what we have understood so far, that if the 1-year interest rate is in US is 2% and India is 6%, so USD should be trading at a 4% premium. Okay. Suppose if USD INR spot rate is 70 rupees. Okay. And the 1-year forward rate would ideally be 72.80, which means 4% higher from today. So if you look at the spot rate today is 70, and you'll find 1-year forward rate when you go to the bank and ask what is the forward rate. Okay, if the interest parity theory holds true, then the bank will tell you that the $1 is available at 72.80 after 1 year. Okay, so this is what the interest parity theory says. Now, if 72.80 is now 72.80 is referred as no arbitrage forward price. So that means if this price is there 72.80, then there is no chance of any arbitrage, because exactly 4% the dollar has depreciated, which is the interest rate differential. Or rupee has depreciated by 4%. We can look at any way what we want. So that means the interest rate differential is actually played out in a true sense in the forward market, and the arbitrageurs have no chance to make money. So there is no chance of any arbitrage. But if the 1-year forward rate trades at any rate other than 72.80, it would present an arbitrage opportunity. So now let's understand what is this arbitrage. How an arbitrager makes money. Okay. If the rate is not equal to 72.80, if it is something else, then the arbitrages will come into play. Okay, arbitrage will enter into the arena. So now let's say if it trades lower than 72.80, let's say at 72.50, then one can exploit the arbitrage opportunity. That means the rupee has not depreciated to the extent of 4%, it has depreciated less than 4%. Okay, the first box which I showed you. Okay. Fine. So, thus borrowing at 2% in US dollars and converting the same at 70 rupees, which is the spot rate today. So, you bring money from US in terms of US dollars. Okay. You borrow from there, pay 2% and bring those dollars. Okay. And convert those dollars at today's rate, which is 70. And at the same time, enter into a forward contract. Okay, to buy US dollar 1 year forward. Why? Because when you bring money in India and you have invested, say, for 1 year, and after 1 year you would like to take that money back. So you will go to the bank and say that I want a 1 year forward rate because I want to take my money back. So you enter into a contract, a forward contract. This is called covered interest rate arbitrage. You're covering yourself. And then when you bring the money in India, you converted your dollars into rupees. Now you put those rupees at work or invest that money in India at 6%. So these are the various steps involved. The step number 1, borrow money in US. Okay, you have to pay 2% at a later time. Convert those dollars at the spot rate today. And at the same time, book a forward contract to take your money out after 1 year. And the rupees which you have today, put it in an investment in India at 6%. So if you do all these steps immediately, the transaction would result in an arbitrage profit of 0.43%. So what will happen? You will make almost like a 0.5% profit, sure profit. The arbitrage profit is always a restless profit. So you have booked all your corners, you have got 0.43% return on your investment. Okay, or a 0.3% gain on your money. Okay, fine. So how the 0.43% has been arrived? So arbitrage profit of 0.43% is equal to minus 2%, the cost of borrowing. So when you're borrowing in US, you're paying 2% there, minus 3.5%. Okay, which is basically, today rate is 70, and after 1 year, the rate is 72.50, you book the forward contract. So the dollar has appreciated by 3.57%. If you look at the bottom of the slide, it is 72.5 minus 70 divided by 70 into 100. So that means the dollar has appreciated by 3.57%. It should have appreciated by 4%, but it has actually appreciated by 3.5%. So on how much less? 0.43, which is exactly the profit you're getting here. So you book a forward contract, at 3.57 for cost of and buying cost of selling US dollar. That is the time you brought the money in India, and then buying $1 US forward. So what you're doing, you're making when you're this is the kind of a cost for you, 0.35%, which is the cost of selling dollar today and buying the US dollar 1 year forward, plus 6% gain which you made by putting money in India. So it is minus 2%, minus 3.57%, which is basically the dollar appreciation which has happened to the extent of 3.57% and not 4%. Okay. As per interest parity theory, should have gone up by 4%. So that's why this arbitrage ability has come to play. And then you gain plus 6% by putting money in here. So all this mathematics gives you a 3.57% of gain. 0.43% of gain. So this is when the dollar has not appreciated to the extent of the interest rate differential, or rupee has not depreciated to the extent of the interest rate differential. So if that is the case, then you borrow at a lower interest rate currency and invest in a high yielding currency. Okay, India is getting 6%. So looking at this and then going back to the first box here, look at the first box. Covered interest arbitrage has an advantage as there is an incentive to invest in a higher interest rate currency to the point where the discount of that currency in the forward market is less than the interest rate differential. So in our example, the discount on the Indian currency is less. It is 3.5% odd as against 4%. So it makes sense to invest in a higher interest rate currency. Okay, so let's go back to this. So this is the money which you are making. Okay. Now this is the normal arbitrage. Now let's go for a reverse arbitrage. If it trades higher than 72.8, now the forward rate should be 72.80, which is called no arbitrage rate, where exactly the interest rate differential is playing out in reality. Let's say the rate is 73. Okay, so that means the rupee has depreciated more than 4%, or the dollar has appreciated more than 4% compared to the rupee. So the arbitrage will come into play. Then one can exploit the arbitrage opportunity by borrowing in India at 6%. So now you do just the reverse, what you had done earlier. So borrowing in US in INR at 6%, converting the rupee to 70 at 70. That means you borrow money in India and convert all your rupees at the 70 rupees dollar and take that money out in US and invest at 2%. Okay, and entering into a forward contract at the same time by selling your dollars at 73. Because after 1 year, when you put the money at 2% in America, and after 1 year you like to bring that money back to your home country, so you will be selling those dollars which you have invested in America and taking it back to India. So at that time you will get 73 rupees later. When you were taking your money out, you're getting 70. When you took your money out from America, you're getting 70. So you have already gained 4.2%, 4.28%. Look at the bottom of the screen. So 73 minus 70 upon 70. So by simply taking money out and bringing in India after 1 year, you are making 4.28%. So which means if you look at the maths, the transaction would result in an arbitrage profit of 0.28%. Okay. And the arbitrage profit is what? Minus 6%, which is the cost of borrowing in India, plus 4.2% the gain in the currency. Okay. Plus 2% money which you are earning by putting your money in America. So you make an arbitrage profit of 0.28%. So this transaction would result in an arbitrage profit of 0.28%, since the interest of rupees 3 on 70 for 1 year is equal to 4.28. So if you find that when you took out your dollars in America at 70 rupees, when you borrowed your money in Indian terms, and you took that money out of India, so you converted your rupees into dollars 70 rupees, and when you brought the money back from America, it became 73. So when you were bringing it, you actually booked a forward contract at the beginning of the time when you invested the money. So you booked a forward contract to take out your dollars, okay, to sell your dollars. So the forward rate was 73 bucks. So you entered into forward contract for bringing the dollars back to India. So by this process, you gain 4.28. So there is a negative 6% borrowing cost in India, a positive 4.28% through a forward contract, and 2% the money which you deployed in America. So you get 2%. So all this makes a 0.28% gain to you. Okay, I hope you have followed. If you have followed this, so kindly put it on the chat line so that we can move forward and understand something else. But this is very important because many questions in the exams are based on this philosophy, okay, or in this concept. So if you have understood, so please say yes, so that we can understand, we can go forward, okay? And just wait for your response for a while, and so should we move ahead and go forward? Just waiting for 1 minute more for your response, and then I'll be. Okay. This is only 3. Okay, so Managem saying, is this arbitrage loss since only 3.57% increase, since 4% increase in expected? Yeah, absolutely, yeah. You're right. So let's go back and understand this, what Sumit is asking. So this is the first case where, the dollar has not appreciated to the extent of 4%. It has happened only till 3.5%. Yeah, because the dollar has appreciated by 3.5% or 3.5%. It should have actually appreciated by 4%. Okay. So since it has not happened, so the arbitrage opportunity has happened. So it should have gone up to 4%, but it has happened only 3.57%. Now, if you look at this, look at these two boxes, it will give you a clarity. So the covered interest arbitrage has an advantage as there is an incentive to invest in higher interest currency to the point where the discount of that currency in the forward market is less than the interest rate differential. Okay. So covered interest arbitrage has an advantage as there is an incentive to invest in a higher interest currency to the point where the discount of that currency in forward market is less than the interest rate differential. Now, since the US dollar has not appreciated up to 4%, okay, or the rupee has not, has a discount of 4% compared to the dollar, so it will always better to invest in higher interest rate currency, okay. So that is the covered arbitrage. But if the second case, if the discount on the forward market of the currency with a higher interest rate becomes larger than the interest rate differential, then it pays to invest in lower interest rate currency and take advantage of the excessive forward premium. So basically what you're doing is you're taking the advantage of the excessive forward premium because the dollar has appreciated by more than 4%. Okay. It should have appreciated by 4%. It has appreciated by more than 4%. So you take the advantage of the forward premium by booking a forward contract. Okay, fine. So I think that covers everything. So I think you people have followed. So, but you have the slides. You can always pose your questions in the next time when I appear on the screen next time. Okay, so let's now begin with the formula for interest parity theory. Okay, so the formula for interest parity theory is, according to the interest parity theory, the forward rates are dependent on the prevailing interest rates in the two currencies. According to the interest parity theory, the forward rate are dependent on prevailing interest rate in two currencies. So the formula is F upon S is equal to 1 plus rate of interest of the home currency divided by 1 plus the rate of interest in the foreign currency. Okay, so where F and S are the future and the spot rates of the currency rates, and RH and RF are simple interest rate in the home and foreign currency. Okay, so look at the formula. The formula says if I have to calculate, what should be the forward rate of a currency pair, then it should be forward rate divided by the spot rate is equal to 1 plus the rate of interest prevailing in the home currency divided by 1 plus rate of interest prevailing in the foreign country. So let's use this thing to do a question. Okay, so let's do some practice questions. I'll put the question and then we'll do it on a board this time. So exercise number 1. On 1st April, 3 months interest rate in UK, pound and US dollar are 7.5% and 3.5% per annum respectively. So on 1st April, 3 months interest rate in UK, pound and US dollar are 7.5% and 3.5% per annum respectively. UK pound oblique US dollar spot rate is 0.7570, which means $1 is equal to so many pounds. What would be the forward rate for US dollar for a delivery on 30th of June? So today is 1st April and we are saying April, May and June. So 3 months rates we're talking about. Okay. So fine. So please look at the question. So we are moving to the board now. So we'll be solving this question now. So in the meantime, you can use the theory, the formula to solve it, okay? So the question is given that on April 1st, 3 month interest rates are given. Between UK and US. So UK it is 7.5% and US it is 3.5%. Okay, so UK it is 7.5, USA it is 3.5. Now looking at the interest rate parity theory, definitely US would be trading at a premium compared to UK. Okay, now the rate is given $1 is equal to rupee sorry, not rupee, $1 is equal to pound 0.7570. Now the quotation is given like this, pound oblique dollar. Okay, so $1 is equal to, so this is written in the right notation. So let me just check that. So $1 is equal to 0.75. So yes, in $1 you have less pounds. You know that. Okay, a pound is costlier when you compare it to the Indian currency terms. Pound is equal to $100 and dollar is equal to say $75. So in 1 pound you will have lesser pounds. So the quotes are rightly in order. So we can proceed further. So we know the formula is F upon S. Okay, F upon S is equal to 1 plus RH, 1 plus RF. Fine. So this is the formula what we are going to use. Okay. So which is, I'll just rub this formula to write at my hand level. Okay. So it will be, forward rate is equal to, so I'll take the S here, which is, pound 0.7570 and multiply this by 1 plus, the rate of interest is 7.5. So I can write it as 0.075, okay, divided by 4, because since it is a 3-month thing, so this is per annum rate of interest. Okay, so this is per annum. So since 3 months interest rates, it will be 0.075 divided by 4, divided by 1 plus, okay, 0.035 divided by 4. Okay, so I can rewrite like this. So this 7.5 can be written as like this, and it has to be divided by 4. Okay, fine, for making a 3-month period. So this also becomes a 3-month period. Okay, so I will solve this. So forward rate is equal to what? Fine. So if we solve this now, so which is, pound 0.7570 into say 1.01875 divided by 1.00875. 875, yeah. Right. So I'll get the answer. So that means this will be equal to your pound 0.7570 into 1.009913. Okay. So we'll get $1 forward rate. Okay. So this is the forward rate, which is a 2 months forward rate, okay, or 3 months forward rate. So 3-month forward rate of $1 is equal to pound 0.7645. Okay. So this is what we get, the answer. I hope you have understood. Okay. So now we will just, we'll do yet another question. So I'll ask you to do a question, okay, based on this. I think we lost the contact in between. So, so what I'll do is that Okay, so answer you're getting is 0.7645. Yes. So, let me just, I think we just lost the contact for a while. So let me just, do it on the screen itself through the slide share. So this is the question, okay? So the rate of interest in UK is given as 7.5%, and US it is given 3.5%, and the spot rate is given. Okay, so what should be the forward rate for US dollar on 30th of June? Okay, so so this question has been solved like this, where $1 is equal to pound 0.7570. This is the spot rate. So then we use the formula, okay, and take the interest rates. So it is, the interest rate in UK is 7.5%, and in US it is 3.5%. So this is for, we have to do it for, this is the annual rate of interest. So we have to do it for we'll divide by 4 to arrive at a 3-month forward rate, okay. So we'll divide the interest rate by 4, both sides, both numerator and denominator, and multiply, and we get the forward rate as $1 is equal to 0.7645. Yes, Sumit, you have got it right. So now, let's, go to this question, exercise number 2. So I'll ask you to do this question yourself, okay? So we'll not move to the board because I think we got disconnected earlier. So please try to solve this problem. The rate of inflation in India is 8% per annum, and US it is 4%. The current spot rate for USD in India is 74%. What will be the expected rate after 1 year and after 4 years, applying the purchasing power parity theory? Now, the formula remains the same, whether we are using a purchasing power parity theory or the inflation interest rate theory. Instead of rate of interest, it will become the rate of inflation. So let me just show you this question, and then you can solve some other question later on. So now, if you look at the a forward rate, so the rate of inflation in India is 8%, in US it is 4%. Okay, and after 1 year we have to find the forward rate. Okay, so the end of the 1 year, it will be 74 into 1.08 divided by 1.04, and the forward rate will be 76.85. And similarly, if you want to do it for 2 years, 3 years, and 4 years, so in the 4th year, so we'll keep doing it, or we can just simply say 1.08 raised to power 4 divided by 1.04 raised to power 4 to calculate the 4th year rate. So the rate will be 86.06, the forward rate. I hope you have understood. So if you have understood, so please say yes on the screen so that we can move to the next question. Or if you have any questions to ask, please ask me. So in this case, we have found the forward rate of rupee for the 1st year, 2nd year, 3rd year, and the 4th year. Of course, in the question it said to find out the rate for the 1st year and the 4th year, but we have done for the 4 years individually. Or you can just apply a shortcut for calculating the 1st year and the 4th year. Okay. So this is simply the rate of inflation in India divided by the rate of inflation in America. So we found the rates. Okay. So now this is a very important question. Okay. So please focus on this question. I'll be, I hope you are able to listen to me. Okay, have you understood what we have done here? Say yes, so that we can move forward. Okay, so let's move forward now and let's understand some more questions, okay? So this is an example. Citibank quotes Japanese yen versus USD at 105 dash 106.5. So bid and ask rate of $1 is given to you in terms of Japanese yen. So this is a Citibank quote, and the Hong Kong bank says that USD Japanese dollar is equal to 0.0090 dash 0.0093. Okay. So are these quotes identical? If not, is there any possibility of arbitrage? If there is an arbitrage opportunity, how would you profit from it? Okay. I'm not getting anything on the chat line at the moment. So are you able to so just checking whether the connection is all right. Okay, so just look at this question and tell me whether are these quotes identical? Number one. If not, is there any possibility of arbitrage? If there is an arbitrage opportunity, how would you profit from it? Okay, so this is the question which is coming. Okay. Okay, I hope you are able to listen to my lecture. Okay, so now let's start. So this is an example. Citibank quotes, they have given a quote for Japanese yen and US dollar, and Hong Kong Bank is giving a quote in terms of US dollars. So are these quotes identical? If not, is there any possibility of arbitrage? Okay, so let's understand that. So Citibank quotes are Japanese yen versus US dollar 105 and 106.5. And Hong Kong bank quotes US dollar versus Japanese yen as 0.0090 dash 0.0093. Okay. So are these quotes identical? Okay. So I think I have now got, yeah, fine. So Citibank has given a quote and Hong Kong Bank has also given a quote. Okay, so are these quotes identical? Okay, so what we'll do, we'll just put these quotes in this order. So Citibank has given Japanese yen versus US dollars 105 dash 106.5, which means that $1 is equal to Japanese yen of 105 bid rate and ask rate as 106.5. Hong Kong Bank has given the rate in the reverse order, which is USD versus Japanese yen. So which is 1 Japanese yen is equal to $0.00900 and $0.00930. Okay, fine. I hope you are listening and understanding. So please say yes if you are able to hear me properly. Okay. So now what we'll do, we will convert this quotes in proper order. So the Citibank quote will remain as it is. Okay, 105, 106. We will convert the Citibank quote into US dollars. Okay, so Citibank quote we are actually changing a bit. We are making it alike with the Hong Kong quote. Okay, so this I have done by reversing the two quotes and converting them in dollar terms. So that means 1 Japanese yen is equal to so this is the quote, 1 Japanese yen is equal to $0.00939 and 0.00952, whereas the Hong Kong quote is already in terms of dollars. So now we see that both the quotes are different. Okay, so we find that Citibank, the Japanese yen is more expensive compared to the Hong Kong bank. Okay, so you can see the Citibank quote is higher compared to the Hong Kong bank. So what you will do then, you will, buy from Japanese yen. You will buy Japanese yen from Hong Kong bank, which is available at 0.00930 and sell them to the Citibank. So in this case, what we are going to do is that you are going to buy the Japanese yen from Hong Kong Bank, which is available cheap. Okay, one Japanese yen is equal to $0.00930, and you are going to take that dollar and sell in the Citibank. So when you buy the rate, buy Japanese yen, you look at the ask rate. Okay, so it is 0.0093. But when you sell, you look at the bid rate. So you go to the Citibank and look at the bid rate, and you find this is the rate at which you can, sell those Japanese yen. So you will be able to sell at much higher rate, which is 0.00939. So buy Japanese yen from Hong Kong Bank at 0.00930 and sell them to Citibank at the rate of 0.00939. So gain of 0.0009 per yen. So if you have 10 crores of yen, you make a profit of $9,000. Okay, fine. I hope you have got it. If you have understood, please say yes. Or if you want, I should repeat it again. I'll do that. So let me just show this question again. Now these are the quotes, original quotes. Citibank has given that $1 is equal to 105 yen if you want to buy from us. If you want to, if you want to sell those currencies, you will get 105. But if you want to buy from us, you have to pay 106.5 Japanese yen. Similarly, in the Hong Kong, it is given in terms of dollars. So one Japanese yen is equal to 0.0090, which is a bid rate, and 0.0090, which is an ask rate. Now we have to say whether these rates are identical. So first of all, we have to convert them in identical terms. So what we do is we convert the Citibank quote in terms of dollars, so that we can compare the Hong Kong and the Citibank rate. So we find that how we do is that we just take the reciprocal of that and change from ask to bid and bid to ask as the formula which is written on the top. And then we find the rates are perfectly in order. So the Citibank, the Japanese yen is costlier compared to Hong Kong Bank. So this is the case. Citibank, the Japanese yen is selling a little higher compared to the Hong Kong Bank. So what we can do is we can, buy from the Japanese yen from the Hong Kong Bank, which is available at $0.00930, and sell that into the Citibank at $0.00939, so that we make a gain of $0.0009 per yen. So if you have 10 lakh yen with you, you can go and buy Japanese, yen from Hong Kong, and then you can make a profit of, say, 90,000. Okay. So let's say now there is an alternate solution also. Instead of converting the Citibank code, we can convert the Hong Kong code in dollar terms. So if we do that, then we find that the quotes are not identical. So in Citibank, the rate is 105, whereas the Hong Kong Bank, the rate is 107.52, and the quote is 111.11 in this thing. So which means you can basically you can buy US dollars from Citibank at 106.50 and sell them to the Hong Kong Bank at 107.52. So you make a gain of 1.0 yen per dollar. Okay, so that is what we have done. So just see whether everything is moving order. So I'm not hearing anything. So let's just check. Jay, are you there? So have you understood the last question? So if you have understood, if you have any questions, please do ask me. Okay. So I'll just wait for your response. So let me just, do a MCQ so that I can understand you people are with me. Okay. Hello.
Are you able to see me now?
ये कब से नहीं हो रहा था? अच्छा ठीक, हाँ कुछ ठीक, ओके चलो फाइन, सो लेट्स स्टार्ट. Okay, so we are moving to a question. Okay, so we are doing exercise number 3. I think you are all there. So have you understood the exercise number 2 which we did? If you haven't, so please tell me. I'll just repeat that. Okay. So we lost the connection for a while, so we are back again. So so let's look at this question. Okay. If the present interest rate for 6 months borrowing in India is 9% per annum, and the corresponding rate in US is 2% per annum, and US dollar is selling at India at $64.5. Okay, so these are the things which are given to you. Will US dollar be at a premium or at a discount in the Indian forward market? So the question is, will the US dollar be at a premium or at discount in the Indian forward market? Find out the expected 6 months forward rate for US dollar in India. Last, find out the rate of forward premium oblique discount. Okay, so this is the question which we have to solve. So, so please look at the question so that we can solve it. Okay, fine. So the present interest rate for 6 months borrowing in India is 9%, and the corresponding rate in US is 2%, and US dollar is selling in India at 64 rupee 50 paisa per dollar. First part of the question says, will US dollar be at a premium or discount in the Indian forward market? Find out the expected interest, find out the expected 6 months forward rate for US dollar in India, and find out the rate of forward premium or discount. So let's do it. So under this circumstances, dollar is expected to quote at a premium in India as the interest rate is higher in India. So the first question was, will US dollar be at a premium or at a discount in the Indian forward market? Yes, US dollar will be at a premium because the interest rate in India is 9%, whereas US is 2%. Okay, fine. So under the given circumstances, US dollar is expected to quote at a premium in India as interest rate is higher in India. Okay, fine. So wonderful. I think you have got it at a premium. Who has done it? Sumit Chen. Yeah. So now we will use the use the formula. So India interest rate is 9%, and India it is 9%, and in America it is 2%. So we will calculate the forward rate. Okay, so we will take 1.09 divided by 2, since it is we have to find a 6 months forward rate. Okay, if you look at the question. Okay, so and then we'll do 2% for America. So we'll divide by 2. So the forward rate will be 66.74. So which will be 64.50 multiplied by 1.045 divided by 1.01. So we want to calculate a 6 month forward rate. So which is 66 point. Now, if you want to calculate the premium, so we'll say 66.74 minus 64, that is the forward rate minus the spot rate divided by the spot rate into, here the months are given, so 12 divided by 6 into 100. So that means rate of premium is 6.94%. So this is, we have calculated. First, the question was whether the US dollar will be at premium. Yes, it will be. Why? Because the interest rate in US dollar is lower compared to the interest rate in India. Second, we use the interest parity formula to calculate the forward rate. And then the rate of premium we calculated using the formula, which comes to 6.94%. Okay. So, so let's do, let's look at this question. Okay. So you will solve this. Okay. So please solve this question. Okay. Fine. So US dollar is selling in India at 74.86. Interest rate for 6 months borrowing in India is 8%. And the corresponding rate is 2% in America. Do you expect US dollar to be at premium or at discount in the Indian forex market? What will be the expected 6 months forward rate for US dollar in India? And what will be the rate of the forward premium or discount? So please do calculate, make your calculations and put the answers for all these three. Okay. So please answer this question. Okay. So the question is on your screen. So I'll give you just a couple of minutes to answer it. Okay. Okay. So I just show you the solution, and though it was supposed to be done by you. Okay. This is the answer which is there. Okay. So then I'll move on to say another question. Okay. So we go to the exercise number 4 now, which will be most likely the last exercise, and then we'll have an MCQ session followed by it. Okay, fine. So this is your exercise number 4. Following are the spot exchange rates quoted at 3 different forex markets. So this is a pretty interesting question. Following are the spot exchange rates quoted at 3 different forex markets. So USD INR rate is 48.3 in Mumbai. Of course, this is a little older rate. Okay. So when US dollar was equal to 48 rupee 30 paisa in Mumbai, and Great Britain rate versus the Indian rupee is 77.52 in London, and Great Britain versus US dollar is 1.6231 in New York. So these 3 rates are given to you. The arbitrator has rupees 1 crore, assuming 1 crore US dollars, assuming that there are no transaction costs. Explain whether there will be any arbitrage gain possible from the quoted spot exchange rates. Okay. So following are the spot exchange rates which are given to you. US versus dollar. That time it was 48 rupee 30 paisa in Mumbai, and Great Britain versus Indian rupee. So one pound was equal to 77.52 rupees, and then the Great Britain versus US dollar, it is 1.6231 in New York. Okay, fine. And if you can just see this quotation, it is written in reverse notations. Okay, so you should be careful. So let's go. Now, USD INR rate is 48.30 in Mumbai. So which means, and of course, the GBP versus INR is 70. This is what is given, and this is what is given. We have seen in the question. So that means one Great Britain pound is equal to 77.52. Okay. And we also know that one Great Britain pound is equal to USD 1.6231. Okay. So these are the two things which are there from the quotes which are given to us. So which means that 1.6231 US dollar is equal to 77.52. So what we have done is basically we have put 1.62 equal to 77.52. Okay. So because both sides you have a 1 pound, so we write $1.62 is equal to 77. So which means 1 US dollar is equal to 47.76. Okay. So in abroad, the dollar is equal to 47.76. But in India, it is 48.30. So sell dollar in India, because you can sell that in India and buy it abroad. You will get cheaper. Okay. So how do we do that? So let's see. So the arbitrager can proceed as stated below to realize the arbitrage gains. So US dollar versus INR is 48.30 paisa in Mumbai. So he is going to sell dollar. Okay. As I said, sell dollar in India. So sell dollar and buy rupee with 1 lakh crore US dollar at Mumbai. So he is going to get 48 crores 30 lakh rupees. By selling 1 crore dollar, he is going to get 48 crores 30 lakh rupees. Okay, fine. So then he is going to take this money and go to London and convert that into Great Britain pound. So we know that 1 pound is equal to 77.52. So we have to convert rupee into Great Britain pound. So we are going to just divide it, okay? Because the quotes are in rupee, in Great Britain pound. So we will divide all this rupees to arrive at Great Britain pounds. So 48 crores 30 lakhs divided by 77.52 will give him pounds to the extent of 62 lakh 30,650 pounds, 0.155 cents also. So this is, he's going to convert his rupee into pounds. Okay. Then he is going to, convert those pounds into dollars. Convert Great Britain pound to dollars at New York. So 62 lakhs 30,650 pounds multiplied by, because 1 pound is equal to $1.62. So that means 62 lakh 30,650 pounds will be equal to 1,112 $1,12,968. Okay. So which will, give him a gain of, so 1,12,968 dollars minus $1 crore, which he had originally. So his dollars will go up to by $1,12,968. So I'll just, go back and repeat this question so that you are not understood. So what he is going to do is, the first step he is going to do is, he is going to convert all his dollars into rupees. So we know that $1 is equal to 48.30. So he'll convert $1 crore into rupees. So he'll have 48 lakh 48 crore 30 lakhs rupees with him. Then he will go and convert that into a pound. Okay. So when he converts his 48 crore 30 lakhs rupees into pounds, so he will have 62 lakh 30,000 odd pounds with him. Okay. So these are the pounds he had got. So now he is going to convert pounds into dollars and see, how much he gains. We know that 1 pound is equal to $1.62. So that means 62 lakh 30,000 pounds will be equivalent to 1 crore 1 lakh $12,968. Originally he had $1 crore. Now he has got 1 crore 1 lakh $12,000. So how much money he has gained? He has gained 1 lakh $12,968. So this is the amount of money he has made by the arbitrator has. This is the money he has made. Okay, so so let's now do some questions. Okay, which are MCQ questions. Okay. Okay, so this is the first MCQ. Okay, so these are the MCQs we are starting now for the remaining period. So we'll be doing just 2 MCQs for the session. So in the interbank market, spot rate is 75.59/6900 per US dollar and exchange margin is 0.1%. Then the spot merchant bank rates are likely to be without rounding off. So tell me what should be the right answer without rounding off. So in the interbank market, spot rate is 75.59/69 per US dollar and exchange margin is 0.1%. Then the spot merchant rates are likely to be A, B, C, or D. So what should be the right answer? So please answer it. So I'm just waiting for your answers. Okay, PPT is not visible. Okay. Okay, is it visible now, Ambika? Is the PPT visible now? So the question is that in the interbank market, spot rate is 75.59/69, and exchange margin is 0.10%. Then the merchant rate would be like, what will be the merchant rates? Okay, so please answer this question. Okay, just see the questions can come back on the screen. So what is the problem? Okay, so is the question visible now on the screen? So this is the question, okay? I think now the question is visible. Is this question visible now? So I just, is the question visible now? Say yes or not. Acha. But yeah, because many students are writing the PPT is not visible. So that's why I'm saying. Okay, fine. So please solve. Yeah. Okay. So we are just going to end now in a couple of minutes now. So let's do just 2 MCQs. Okay. Fine. So please put the answer. The answer is 75.5144. The right option is the choice number A. Okay. Fine. So let's do the second question now. Hedging is used by corporates to decrease the variability of expected cash flows, decrease the variability of income tax paid, increase the variability of income tax paid, increase the variability of forecasted fund flows. So what should be the right answer? Okay. So hedging is used by corporates to do what? Decrease the variability of expected cash flows, decrease the variability of income tax paid, increase the variability of the income tax paid, or increase the variability of forecasted fund. So what should be the right choice? The right choice is decrease the variability of the expected cash flows. Okay. Now we come to the third one, okay, which we haven't done. If the price on a future date is higher, then the currency is set to be at forward premium or forward discount. Okay, so yeah, you are right, Manoj, Ambika. So if the price on the future date is higher, then the currency is set to be at forward premium. Okay, fine. So the answer is A for the forward. Okay, let's do this. If the forward rate is less than the existing spot rate, it contains a discount or a premium. So it contains a discount. Okay. So then the currency which carries a lower interest rate is always at a dash versus the other currency. So what should be the right answer? So the right answer should be, it should be at premium. Okay. So let's go to the seventh one. So this will be perhaps the last question of the day. Interbank exchange rates are dash dash dash, which are applicable to transaction among dash. So tell me what is the right choice. Okay. Yeah, forward premium. Yeah, Sumit Jain is correct. So please answer this now. The last question. Okay. Fine. Interbank exchange rates are what? Which are applicable to transaction among? So please answer this question. So interbank exchange rates are wholesale rates which are applicable to transaction among banks. So seventh is, answer is A. Yeah, absolutely right. Yeah. So, okay, then we just ended the session for the day and see you day after tomorrow. Thank you very much. Okay, Jay. So we end up the session here now.